I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a guy that wrote a book about 2013 called The Coming Bond Market Collapse. I'm kind of giving it away here. He is a money manager. He is a financial expert. He runs Pento Portfolio Strategies. I'm talking about Michael Pento. Michael Pento, thank you for joining us today on USAWatchdog.com.
Thanks so much for having me back on the program, Greg.
I'm not that smart, but even I can tell that interest rates have gone up a long way from not that long ago. They were, I don't know, 1.5%, and now they're 2.9%. We have a lot of debt, and there's a lot of derivatives, and there's a lot of stuff that can go wrong with rising interest rates. Why don't you tell us what can go wrong with rising interest rates?
Well, there's so many things can go wrong with rising interest rates. But first of all, you have to understand that the perma that you hear on CNBC will just tell you there's nothing wrong with rising rates. It's just a symbol of growth. Well, if you look at industrial production and retail sales for January, they were negative. So rising rates are occurring not because of growth. They're caused by insolvency concerns. That is the key metric here. Credit risks and insolvency concerns. That is leading to rising rates, period.
What kind of things can go wrong with the rising rates and insolvency concerns? Are you talking about? I don't know. Not that long ago, the IMF was talking about just Deutsche Bank about being the most systemically problem bank, and now they came up with another eight to go on with that. Are you talking about insolvency like that, or insolvency with businesses? What are you talking about?
Well, first of all, let's just talk about where rates were and where they're headed and what could happen. So, in 2016, the summer of 2016, the U.S. 10-year yield hit 1.4%. And if they go to 4.4%, so it's not too far away from where we are now. We're at 2.9 on benchmark U.S. 10-year. They go to 4.4%. Investors will lose 24% of their value, a little bit over 24% of their value in risk-free treasuries, Greg. Okay? So, you think about you're putting your money in a risk-free treasury. For 37 years, all you've done is gotten an increase in your principal. But now that's all going to reverse. So the math for bonds works like this: 1.4 to 4.4. You lost almost a quarter of your entire value. Talk about a panic out of treasuries. So let's say let's just ask ourselves this question: where do we think interest rates will go? So I look back to 2007. That was before central banks were myopically preoccupied with long-term interest rates, bending those interest rates down towards zero. Well, the average yield during 2007 was 4.6%. And 4.6%, you would say, well, that's probably where yields are going to go. But let's look at some other dynamics. The deficit back in 2007, the deficit as a percentage of GDP was 1.1%, just extremely low. And the publicly traded debt, Greg, back in 2007 was $5.1 trillion. Okay, so you have 4.6% average yield. Central banks were out of the game. They were not yet into the game of bending down the yield curve. 4.6% average, yet deficits were 1.1% of GDP. Publicly traded debt 5.1. Let's go to today. Okay, so fiscal 2019 starts in October. The publicly traded debt is no longer 5.1 trillion. It's over $15 trillion. And the deficit to GDP, get this, the geniuses that run DC. Donald Trump hopefully was going to go there and drain the swamp. But Mitch McConnell is the swampiest of all swamp creatures. And what they've done with this deficit now, it is baked in the cake that the annual deficit fiscal 2019 is going to be $1.2 trillion. Now you add on to that $600 billion worth of Fed asset sales. You come up to $1.8 trillion. Well, that's, Greg, get this, please, listeners, viewers, understand this. The deficit to GDP will be 8.6% starting in October of this year, fiscal 2019. So if your publicly traded debt is now 15 trillion from 5, and your deficits went from 1.1 to 8.6% of GDP, it's no wonder why yields are rising. And they're not just going to go from 1.4 to 4.4. I think 4.4 is a floor, not a ceiling, a floor, because of the insolvency and credit concerns that have mushroomed since the Great Recession.
Who's insolvent? Who do you think? Who's your odds-on favorite to be? Huh?
Europe is insolvent. The United States is insolvent. We got $20 trillion, $21 trillion of publicly not publicly traded of the national debt, including intergovernmental debt. Oh, the coverage ratio there, we have it's 7 times our revenue. So we are technically insolvent, and you haven't seen anything yet because as interest rates rise, debt service expenses rise. So the ECB is insolvent, certainly beyond a shadow of a doubt. The Bank of Japan is insolvent. I'll tell you what else is insolvent, not only the United States. You asked me what's going to happen. So as interest rates rise from 1.4, where they were in the summer of 2016, to well above 4%, and I think they're going much higher unless the central banks come back in. We can talk about that a little later. I think the end game is here is that central banks are to come back and buy everything, every fixed income sovereign debt instrument that they can find, because interest rates are going to spiral out of control, just like they did in Europe in 2012. So what we're gonna have here is a collapse in the bond market. I wrote the book in 2013. This is exactly what's occurring now. It's not something that is predicted anymore. It's exactly what's going to happen. And I think as interest rates rise, as I said, it's not just treasuries that are going to blow up. You look at the money that's gone into bond funds. So there's been about $400 billion in bond funds just in the last year, and leveraged loans. So loans to the most riskiest parts of the economic spectrum, they were up 50% year over year. So collateralized loan obligations are going to get destroyed. I mean, Greg, high yield debt now yields a little over 5%. If the 10-year note, the risk-free treasury, goes to 4.5%, 5%, high yield's going to blow up. And you know what's going to happen? I know I'm not letting you in here, but one more point I want to make. You look at what happened to the volatility index, these inverse vol instruments that completely blew up in a matter of hours. So the VIX, which measures the volatility of option premium, that doubled. You know, it was very easy to be short volatility when central banks were buying everything that wasn't nailed down. All you had to do is short volatility and make a fortune. But volatility went up 100% overnight, and inverse vol went to zero in a matter of hours. Well, that's sort of what's going to happen, not exactly to that degree, but that's sort of the dynamics which is going to happen with bond funds. You've got trillions of dollars parked in these passive bond fund ETFs. They're all going to be unwound as the panic ensues as we go above 3 and above 4 on the U.S. Treasury. And by the way, that 10-year note is going to go much higher, and it's not going to happen 10 years from now or 5 years from now. You have deficit to GDP that's over, it's almost double digits. It's almost 10%, 8.6%. That's not even including the debt service costs that are going to skyrocket. And they go higher from there, Greg. So it's a very cogent argument. You're going to have a panic out of treasuries, a panic out of high yield, a panic out of leverage loans, a panic out of bond funds. And boy, oh boy, when the bond funds get liquidated, they have to sell the underlying bonds, which sends yields up even higher. So, this is not something that's guaranteed to happen. This is a very high probability. It's not a fat tail event. And nobody's talking about this risk. Nobody, if you listen to CNBC, the talking heads, all they say is that yields are rising because everything's great. The economy is doing fantastic, and that's why yields are rising, and rising yields are healthy. But shows like yours, USA Watchdog, you get real math, real data, and it lets investors be aware of what could happen, what's probable to happen, and gives them an opportunity to protect against that outcome.
In the pre-interview, you just told me that, the bond collapse, what I wrote about, and I'll just hold it up again. If you wanted to find out what's going to happen, it's still relevant right now because we're right at the beginning of it. This is right at the beginning of what's going on. You're saying that it has started. The collapse has started.
Greg, the average, this is Bloomberg data, the average of the 10-year note prior to the Great Recession, so from 1949 to 2007, the average yield was above 7%. So, why would we be lower than that? The only reason why we would be lower than that is because of central bank asset purchases. Well, the Fed is going to be selling 50 billion per month come October. The ECB is going to be out of QE come the end of this year. And that leaves only the Bank of Japan buying. But on a net basis, central banks will be sellers of assets, not buying $170 billion worth of sovereign debt and corporate debt per month. They'll be sellers of this debt come October.
You're saying that if we
so yields will. I mean, you believe in nature hates vacuums. In nature, things normalize. They mean revert. Why you have to give me an argument as to why there would be no mean reversion in interest rates? And I just laid out the fact that countries have become insolvent coming out of the Great Recession. We had 10 trillion of debt when George W. Bush left the White House.
Roughly.
Now we have 21 trillion in debt.
Yeah.
Deficits have soared. Debt has soared. Asset bubbles have blossomed beyond belief. Why would they not mean revert as central banks remove that thumb from the scale? Don't forget, and I'll remind your viewers that central banks printed $15 trillion worth of bonds since the Great Recession ended, and not coincidentally, about at the peak, $15 trillion worth of bonds had a negative yield. Here's what the perma bulls on CNBC don't understand. Why is it that a sovereign government would be able to issue debt and get paid to do so? Why is it that a European corporation can issue bonds and get paid to do so? Why is European junk debt yielding less than a U.S. Treasury note? It's all because of central banks. And I'll tell you this. This is going to be good. When the central bank, our Federal Reserve, unwinds its balance sheet from $4.5 trillion to around $2 trillion, it's going to be nothing like, quote unquote, watching paint dry, as Ms. Yellen avowed.
Yeah, if you just go to the average 7%, I mean they set the 30-year mortgage off the 10-year Treasury. I know it sounds kind of weird, like they all set it off 30, but anyway, they set the mortgage rates off in LIBOR, but they set it off the 10-year Treasury. If you had a 7% 10-year Treasury, I mean you'd have mortgage rates at 7.5%, 8%. I mean, what would happen to the housing industry?
Well, the housing market is already starting to roll over. I mean, you look at housing construction way below where we were prior to the Great Recession. If you look at home prices, they've been going up significantly. That's all going to roll over as interest rates rise. But even forget about the housing, which is a huge part of the economy. You have to look at the absolute panic that's becoming in the banking system. Banks own these leveraged loan products, and then Wall Street buys the CLOs, collateralized loan obligations, which is comprised of leveraged loans. People, when the central banks took $15 trillion worth of bonds and made them with a minus sign in front of them for the last 9 years, investors all over the world were scampering for yield. Where did they go? They went into high yield bonds. They went into junk bonds. They went into leveraged loans. They went into bond funds, passive.
They went into risky stuff.
They went into the riskiest things imaginable, and the covenants on these loans are gone. So these, used to have something called covenant heavy. Now they're covenant light. There's no recourse really anymore for these loans, these leveraged loans, these loans to basically people who are insolvent. When these loans go bust, banks are going to be under severe duress. Not only that, you look at everybody says the banks have deleveraged. Well, if you look at their tier 1 asset ratios, it's because they don't count sovereign debt as part of those risk assets. They have a zero weighting. When bond prices collapse and yields rise, these banks are going to be insolvent once again. So, it's not going to be watching paint dry. The collapse in the biggest bubble we've ever had in the history of bubbles isn't going to be very calm and happen with impunity. It's going to be extremely disruptive. I want to add this also. You saw what happened a couple of weeks ago when the stock market lost 12, 13% in a matter of a couple of days. As the risk premium goes to zero, so you take the inverse of the earnings yield and you subtract sovereign debt. As the sovereign debt yield rises, that risk premium collapses. and you just don't get paid for that risk. You don't get paid for the risk in stocks. You don't get paid for the risk in junk bonds. So you're going to have for the first time, Greg, in the last around 40 years, you're going to have bond prices and equity prices in free fall. That happened throughout most of the 1970s. It's going to be even worse because in the 1970s we didn't have an insolvency concern. We have credit risk and insolvency concerns that are off the charts. So these are things that I model, I look for. I'm not a passive investor. I don't have the idea that you should just buy 50% or 40% bonds and 60% stocks, depending on your age, and just buy and hold. And every down dip is an opportunity to buy. It's not the case. This is not normal. Never before in the history of global finance have central banks completely warped every single asset price out there. And the unwinding of that is going to be extremely volatile. And if you're not positioned correctly, very, very painful.
When you say unwinding, there's going to be a lot of people, this debt's just going to get washed out, right? I mean, they're not going to be able to pay it. At some point, somebody says, okay, we can't pay it. I mean, at some point, the debt's going to go to Zippo. It's going to be those bonds or nothing. I mean, are they not?
So according to the Bank of International Settlements, 10% of all corporations don't have enough EBIT, so earnings before interest and taxes, to cover interest expenses. They don't have enough. They don't have enough. In other words, their profits aren't even enough to cover interest expenses. That's 10% of the world's corporations. So how have they even existed in the past 8-9 years? By issuing debt to pay debt. So when yields rise, it's very likely that a high percentage, maybe even all 10% of these, they call them zombie corporations, go out of business.
Wow.
Now then you have the
millions of jobs. That would be millions of jobs globally.
Millions of jobs. There would be massive liquidation from corporations of assets and capital stock. That's what you're going to have. You're going to have another recession, but this recession is going to start incredibly with asset prices at 150% of GDP.
And we are rolling down the runway. We're not on the runway. We are on the flight path to take off.
That plane is already gaining. It's on its way to cruising altitude. I mean, we've already, like I said, 2016 July 1.4%. We're at 2.9%. There's nothing stopping these to go above 3%. Risk premiums are going to collapse. Now, the only thing that could mollify or retard the advance of yields is a complete collapse of the economy and the stock market. But then on the other side of that, you have to remember what happened in 2012. You had yields in Greece going 200% on the Greece 2-year note. Italian bonds were 8% instead of where they are today, about 2.5%. The German Bund was 4.5%. Today it's 0.7%. So it's only because Mario Draghi decided to buy everything in the world.
Which gets us to the central banks. So what could they do if they are looking at this panic? You're talking about panic everywhere, panic in the whole markets. What do the central banks do?
Well, they go back.
Panic move.
I even heard today on the way into the office, the CNBC had a show. It was Stephen Messina Bloomberg talking about the need. No, it was CNBC again. Was universal basic income. They were talking about just giving people money. So on the other side of this,
they're talking about communism is what they're talking about.
You're talking about paying people to be fallow and unproductive. As
I said, communism.
As artificial intelligence takes over the world, and people are, human beings are completely fat, stupid, and useless, and we sit here waiting for our pennies coming to us from the government. The benevolent government's going to mail us a check. And so we can sit there and watch our savings and our living standards go to zero. By the way, speaking of savings, the personal savings rate in the United States just hit an all-time low outside of 1 month, 2.4%. It has never been even close to that level outside of one lousy month. So when you think about who the heck's going to buy a deficit that's 8.6% of GDP, there's nobody else to buy it. If the Fed is going to be a seller and Americans don't have the savings. Well, where's the money going to come from? Yields are going to become unglued. So forget about 4%. As I said, 4.4% when you lost 1/4 of your value in your bond fund, in your treasury bond fund, yields are going much higher. Unless the central bank comes in, and here's a point I want to make. The central banks could say, well, we are now going to once again cap long-term sovereign bond yields. So you're going to be printing. So forget about the Fed's balance sheet being drawn down. It's going to go up huge without any hope of ever being shrunk again in the future. But everything else that isn't being bought, in other words, everything else that's not in the purview of central banks' purchases, those yields are going to skyrocket. So again, municipal bonds, leveraged loans, junk bonds, unless they're going to buy those two. Well, if they buy those two, then forget about it. It's hyperinflation like we've never seen outside of maybe the Hungarian Pengo. So I doubt they're going to go that route. So what I'm trying to say is the chaos coming to markets, it's not even coming anymore, Greg. It's here. It's not going away. It's not going to be brushed under the rug. It's not going to stay on the sidelines for another few years. The years from 2007 to 2017 were the halcyon years where central banks were buying everything and there was no volatility and stocks just went up. Those days, not that they're ending, they have ended, and the volatility and chaos is only going to become much more profound.
And you're saying that you said that the biggest overvalued asset out there at one point was the central banks, the belief that central banks can make everything okay. You're saying now that there's no way out for the central banks. They can't do it. They either, if they buy everything, they'd have to buy everything, hyperinflationville, or if they do nothing, we have complete total collapse in value of just about everything. The debt gets washed out. Either way, hyperinflation or total collapse. Is that what you're saying?
Well, that's why you said it beautifully. That's why I run an inflation-deflation model, because if the central banks truly believe, if they're really convinced that they can now step back from manipulating markets, yields are going to go, they're going to become intractable. They're going to rise intractably from quickly rising to the 4% level up to that mean reversion of 7%, and then even higher from there, which is going to wipe out the economy and the stock market. There's no way they can allow that to happen. If they did, we'd have a deflationary collapse of asset prices like we've never before seen. They're not going to do that. They're going to step back in. That's why the volatility between inflation and deflation is going to pick up dramatically. And the swings along that spectrum are going to rise exponentially. So that's what we're in for. There is no easy way out. The central banks maybe have duped themselves. I just hope, thanks to people like you, investors don't have to be duped into believing they have to suffer the third 50% or more haircut in stocks since the year 2000.
And it's going to be 50% down. So how do you protect yourself? I mean, do you just own your stuff, and hopefully you'll have clear title to it, and nobody will come take it away from you? Or what do you do? Do you own your artwork, your gold, your house, your farm, your business? Do you wipe out all debt? What do you do to protect yourself?
Well, like I said, if they're going to go to the hyperinflation route, you should have debt that's tied to a fixed income. That would be wonderful, because then your debt would be wiped out. It'd be like paying back nothing, because the purchasing power of the currency would go to zero.
They're not going to do that.
If they have the deflation, if they go down the deflationary route, then having debt outstanding is very, very pernicious. So what I do is I run an investment portfolio, and during times of deflation, well, I'll invest to hedge towards that condition. So what does that mean? It usually means the dollar will rise. It'll probably mean you have to short junk bonds. You have to short the stock market. You have to own high levels of cash, because cash is going to be appreciating in value. On the other end of that spectrum, and I think we're headed very shortly on the other end of that spectrum, after the recession begins, which I believe sooner rather than later is better for the economy and the country. But unfortunately, the reaction to that is going to be universal basic income, helicopter money, negative interest rates.
Oh, inflationary.
Are you talking about hyperinflation? Absolutely. That's why I think I wrote a piece. I think I might have talked about it here, but I'm not sure if I described it on this venue. Why they're allowing cryptocurrencies? Why are governments allowing cryptocurrencies so much rope to hang themselves with? Because eventually they're going to eliminate cash, that's going to be necessary to impose negative interest rates. And to do that, they're going to have a universal kind of like an American Fed coin, maybe the ECB, or maybe even the IMF will have this government-sanctioned cryptocurrency. And people will be okay with it because, hey, look how successful Bitcoin was.
And what about Donald Trump? I mean, I know you actually voted for Donald Trump. I know that you told me that
I did.
Hopefully, okay. I didn't disclose it either. But you're saying that he walked into a mess. I mean, $20 trillion of debt, and when he got elected, basically, roughly. And but he's trying to get. He opened up Anwar. He's opened up all this oil stuff. He cut all this regulation. He got this tax cut back through. Of course, going to be inflationary. But he's got money coming back to America. Manufacturing coming back to America. I mean, that's his goal, right? He's going to try to pump the economy up to overcome the inflation. Am I wrong?
Well, he's doing all of what you just said. I think he forgot about the other side of the ledger. I mean, I'm all for tax cuts. Hey, tax cuts are very stimulative to growth. There's nothing wrong with stimulating growth. I'm all for it, but you forgot about the spending side of the ledger.
Yeah.
You know, the Republicans are acting like Democrats over in Congress, and we paid for hurricanes and bailouts.
They're scared to death.
We've increased military spending. So you know, and where's the fiscal rectitude coming from? I don't know where it's going to come from. You know, they laughed at Rand Paul. He's one of the few holdouts in the Senate. The Tea Party part of the Congress, House of Representatives, you know, they're kind of like they were completely shut down. So here we are, $1.2 trillion, $1 trillion this year, which is happening now, $1.2 trillion next year. Entitlements have to be renegotiated. That's not even on anybody's radar. They mentioned they give a blind talking point to doing something about them, but there's not a chance in an election year you're going to get anything done with entitlements. So these deficits are baked into the cake. The military, I don't know why the military needs, you know, an extra few $100 billion for wars that we have no business being involved in. But that's what it is. And then you add on top of that, central bank sales. And you wonder why yields are going to go not mean revert, go much higher. So, wow, the volatility is going to be off the charts. And if you're not prepared to at least try to profit from that, protect and profit from that, you're going to be way behind the eight ball.
I know you handle a lot of people with a lot of money, but for people that don't have a lot of money, what should just normal people that don't have tons of money to hire a brainiac like you to manage their millions of dollars, which you are, brainiac. But what do normal people do? They just buy gold, food, pay their car off, buy silver? I don't know. What do they do?
You know. Listen, since 2012, precious metals have been nothing but exasperating to own. I honestly feel, and I've come on your program many, many times telling people, own some gold, not time to overweight gold yet. The time to overweight gold is coming. I think it's going to be this year, and I think it's going to be the fall of this year. Because I think, you know, over and above all the efforts of Donald Trump and what he's tried to do, the economy is going to roll over into a recession. When that happens, the deficit that I mentioned that was $1.8 trillion goes to almost $3 trillion deficits per annum on top of an economy that's only $21 trillion, Greg. Yeah. I mean, this has never before happened. So, you know, if you don't think that eventually, I mean, the market's going to be aware right when the recession occurs, when the revenue plummets and the deficit skyrockets, it's going to be telegraphed very succinctly that central banks must inflate that deficit away. They must return to markets, create dollars, buy long-term bonds, and force those yields lower. And then I think gold's going to skyrocket. So to answer your question, you know, if I only had a few $1,000s to my name and I didn't, you know, wasn't going to top tick a bubble in the equity market or go out and buy a house with almost nothing down when those home prices are going to fall precipitously, buy yourself some precious metals while they're still on sale.
Silver's a deal, 16.
Silver too. Silver, gold, platinum.
Silver's simple and cheap. It's like a Bitcoin. It's cheap. I would say and it's it's so cheap. It's like a mining cost. But anyway, food is also good. A set of tires for your car is I'm pretty blue collar, Michael. I mean, I think brakes and tires for cars that are old. Anyway, Michael Pento, it's right here. This is like Nostradamus right here, man. I'm telling you. I'm going to give it a full screen. This is his book. You can see it still on his website. You can still buy this book. Is that right, Michael?
Yes, of
Yeah.
course.
If you start on chapter one, you basically will start right now, today. It could have been written today, which I find very interesting. And you give an interview on the economy and the bonds and the whole deal, and that is nobody else does. Oh, incidentally, do they not invite you back on CNBC anymore or Fox
No,
Business?
I'm banned. I'm out. I mean, they pretty much told me I'm banned. They don't want to see the likes of me, even on their website.
You're kidding.
No.
And what's the reason for that?
Well, first of all, I don't really care because I'm on quality programs.
I don't know, but I want people to know why.
This is all theory and conjecture on my part, because I don't think they want to exacerbate the panic that they see coming, because they're market cheerleaders. Everything is always great. And when you have someone like me who comes on and can fairly humbly say succinctly comes with data and facts and kind of proves that the theory that everything's going to be normal and the faith in fiat currencies will last forever and the faith in the sovereign bond market of the United States is immutable, I come and punch a hole into that, a pretty big one. They don't want any part of that. So I'm now persona non grata on CNBC, and you know what? As long as I can be invited on shows like yours, I don't care.
Oh, you'll always be on shows like listen, they've turned into propaganda. It's sad. I mean, it's really sad. I mean, I had Stockman on one time and said, "What do they say to you when you're off camera?" He says, "Well, the host, they think I'm crazy, but the people on the set with me, they go, yeah, we know you're right."
Yes,
we know.
You're
is
so.
Is that what they tell you? Do they
Yes,
say? Do they say to you, "I can't
Yes.
believe you said that"? Do they say crap like
Yes,
that to you?
they do. Yeah.
Do
Yes,
they really?
Yes, they do.
They say, "We know you're
Yes.
right."
You're right, but I guess it's a ratings game, and the more who are their
They
sponsors?
say that to you off camera.
Who's paying? Who's paying?
No. They say that to you off camera. They say to you,
Yes.
we know you, Mike.
Yes.
Isn't that
Yes.
sad?
Yes.
Isn't that sad? That's sad. Anyway, I used to have a news director that he said, "I don't want to hear you telling a story about a story," and then I watch the story on the air, and I don't hear that story. Don't leave the good stories in the newsroom. See, that's the good stories. You're telling the good stories. Yeah. You know what I'm saying? Anyway, all right. Listen, Michael Pento, Pento Portfolio Strategies. Thank you so much for joining us. All the links to his website. You have a podcast. You have a newsletter sign up. You have a bunch of stuff. I don't get paid nothing for telling people about this, but I'll send a link to your Pento Portfolio Strategies. Michael Pento, thanks for joining us today on USAWatchdog.com.
Thank you so much, Greg.